Welcome to the Training and Advisory Services TAS online courses. In this course, we will cover International Accounting Standard IAS 2 dealing with inventories. Our learning outcomes: we want to differentiate types of inventories, explain costs of inventory, explain cost estimation techniques, and discuss the disclosure of inventory within the financial statements. Inventory forms part of the working capital of a company, which is the lifeblood of the business, and inventory itself is a significant component. There are many types of inventory that an entity can hold. These include raw materials, work in progress, finished goods, and consumables. Raw materials. These types of inventory are mainly held by manufacturing entities and include materials to be used in the production process or provision of services. For example, soya beans for a cooking oil manufacturer or flour for a bread manufacturer. Work in progress. These are items or materials in the production process for sale in the ordinary course of business. For example, a motor vehicle body awaiting spray painting in the workshop. Work in progress constitutes items that would not yet be complete but would have started within the production process. Finished goods. These are now products that have been completed and are held for sale in the ordinary course of business. For example, a motor vehicle in a car dealer showroom. Consumables. These are items to be utilized in the production process. For example, bolts and nuts used on motor vehicle hinges and lubricants. In terms of measurement, the principle states that inventory is measured at the lower of cost and net realizable value. We will look at this in more detail. Let's look at a knowledge check. The entity purchased an item for $20 and then because the market for the products are depressed, they reduced the price from $25 to $18. The reduction in selling price causes the inventory to now be carried at a cost that is above the net realizable value, and thus inventory should be written down to $18. This is because, in terms of the principle, $20 is the cost and $18 is now the net realizable value, as it represents the value that the company expects to receive should it sell the inventory in an orderly transaction between market participants. Therefore, the inventory now has to be written down to $18, which reflects a more realistic value for the inventory that it currently holds. The cost of inventories. This is a particularly important concept as it is key for the entity to be able to price its inventories appropriately, as failure to account for this cost could lead to either overvaluing of inventories or undervaluing of inventories, which in consequence the company can price itself out of the market or price itself so low that it fails to maximize on profits. Now, the cost of inventory comprises costs of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. There are other costs that a company can incur which should not be capitalized as part of inventory. These are storage costs for finished goods, and this is key because storage costs for raw materials and work in progress could be capitalized to inventory. However, if the storage costs are for finished goods, they will not be included as part of the cost of the inventory. Administrative overheads unrelated to production. Foreign exchange difference arising directly on the recent acquisition of inventories invoiced in foreign currency acquired in other countries, for example, in South Africa or in Botswana or even in China. Abnormal waste. Normal waste can be capitalized as part of inventories. This is expected. However, if there is abnormal waste or abnormal loss of inventory, this will not be capitalized to inventory. Interest cost as well as selling costs will also not be capitalized as part of inventory.